Hi, today I'm going to teach you more about the topic of financial ratios. And I've chosen to teach you more about this topic because financial ratios, in my opinion, are really the core of a company's fundamentals because they are directly tied to a company's financial performance. And besides that, a lot of people know mostly a few basic financial ratios, but there are so many more financial ratios that tell so much more about how a company is actually performing financially. For example, the PE ratio. A high PE ratio could mean that great growth is anticipated, but it could also mean that the company is overvalued. So it, on its own, it means nothing and it says nothing. So you really need a more advanced knowledge of financial ratios to actually make an educated investment decision. And that's what I'm going to do today. I'm going to show you five more advanced financial ratios that I personally use when analyzing a company. The first financial ratio that I really personally like to use is called the PEGI ratio. This was coined by legendary investor Peter Lynch, and it's a modification of the PEG ratio. And this is a company's price to earnings ratio divided by the earnings per share growth rate plus the dividend yield. And this gives you a very comprehensive view of a company's value. And if it's below one, a company is generally considered to be undervalued. What that means is if that company's PE ratio is 20, the EPS growth rate plus the dividend yield needs to be more than 20% for the PEGI ratio to be under one. So the PE ratio might be a bit stretched, but it's justifiable because of a great yield. The next one I like to use is EV to EBITDA. EV stands for enterprise value, which is a company's equity value plus net debt plus preferred equity plus minority interest. So simply said, it's everything on a company's balance sheet except for cash, because that's not really being deployed. That's not working for the company. And EBITDA stands for earnings before interest, taxation, depreciation, and amortization, which is really the core operating profit of the company. So the EV to EBITDA ratio shows you how well the enterprise value is being deployed to generate an operating profit. And you generally want to achieve a high EBITDA with low amount of deployed capital. So you want the EV to EBITDA ratio to be relatively low. And this is especially very powerful in very capital intensive industries. And it also allows you to compare companies with different capital structures. EV to free cash flow is the next ratio I use. And also this is a ratio that relates a company's enterprise value to a company's ability to generate a result. In this case, that result is free cash flow. And free cash flow is the cash that's left at the end of the year or at the end of the period that can be paid to the providers of capital for both equity and debt. And free cash flow is very difficult to manipulate, and therefore it's very often used in valuation models. So it's very relevant. And also this ratio should be low because you want to generate a lot of free cash flow with a very low amount of deployed capital. And now we're getting into more advanced territories, the ROIC-WACC spread. ROIC stands for return on invested capital. It's a company's net income divided by the invested capital. And WACC stands for the weighted average cost of capital, which is the average cost of a company to finance its operations with both equity and debt. And if the return on invested capital is greater than the weighted average cost of capital, value has been created. And if the return on invested capital is lower than the weighted average cost of capital, value has been diminished. So essentially, it shows you whether a company is creating or destroying value with every invested dollar. And the last thing I want to talk about isn't even a financial ratio. It's a composite score based on many different financial ratios. It's called the Piotrowski F score. It's a score that ranges from 0 to 9, and it's broken down in three categories: profitability, leverage, liquidity, and source of funds, and lastly, operating efficiency. And for the profitability category, the points are assigned as following. If the company has a positive net income, you assign it 1 point. If the company has a positive return on assets, you give it 1 point. If the company has a positive operating cash flow, you give it 1 point. And if the operating cash flow is greater than the net income, you assign it another point. For the leverage, liquidity, and source of funds category, if the long-term debt is lower than last year, if the current ratio is higher than last year, and if there were no new issued shares in the past year, you assign every one of those points 1 point. And for the operating efficiency category, if the gross margin is higher than last year, and if the asset turnover is higher than last year, you assign both of these 1 point. And generally, a score of 8 or 9 shows a very solid company, and it has actually been a really, really good predictor of performance in the past. And the score is very often applied in value investing, and it's especially useful for companies with a low price to book ratio. So yeah, that's it for today's video. These are the financial ratios that I personally really like to use when I conduct a fundamental analysis. And I really like them because they create a very comprehensive view of a company's financials, of the cash generating ability, the efficiency, the profitability, and just the overall quality of the company. So it gives me a very complete picture. However, I never use these alone. I always use them together and then also combine them with other quantitative and qualitative data of the business itself. And this is not just the end of this video, it's the end of the entire Teacher series. So yeah, I really hope you yeah, you enjoyed the videos. I of course hope you learned something from them. I definitely did. So on that note, I would like to end. So thank you for watching, and well, maybe see you another time. Bye.